Hello, my name is Kola Toby. So in this session of the class, we are going to be looking at what we call the capital gain tax. We are still under the advanced taxation. Yeah, capital gain tax. Now, basically, when we say capital gain, that's what is the word capital gain. Of course, here we are talking about capital gain occur when the sales proceed on the disposal of an asset is greater than what we call the cost of acquisition, is what we call the capital gain. Which means if I bought an asset for a particular amount and I sold it above the cost of acquisition. For example, I sold an asset for 1.5 million. That's the sales proceed. And the cost of acquisition of that asset is 1.3. I can now say, okay, the capital gain that was made on that asset as a result of disposal is 200,000. So when we say capital gain occur when the sales proceed on the disposal of an asset is greater than the tax written down value. So at that point, we can say, okay, this asset there's a capital gain on the disposal. So that is that. Now, of course, you should be able to know what. Now, what do I look at? What do we call a capital gain tax? Because you have to know what is the capital gain. Now, capital gain tax, it is a tax imposed on the gain, realized as a result of the disposal of an asset. So which means anytime tax authority impose a tax on the gain realized as a result of disposal of an asset, that tax is what they call the capital gain tax. Which means if I sold an asset for 1.5 million and I bought it for 1.3 million, and then the capital gain is 200,000. Now, of course, the tax that is going to be imposed on this 200,000 is what they call the capital gain tax. And you should know that the capital gain tax rate, the rate we apply on that gain is 10%, which means if I want to know the capital gain tax, I'm going to say, 10% of this 200,000, which means 20,000 will give me my capital gain tax, because the tax rate on that gain is 10%. Yeah, it's 10%. So which means my capital gain tax is 10%. So please, you have to note that. You have to know that when it comes to what you call the capital gain tax. So, and now again, let me also talk about what you call the year of assessment for the capital gain tax. Now, the year of assessment for the capital gain tax is actually assessed on actual, which means anytime an individual or a company disposes an asset and there is a gain on disposal, which means that particular gain will be assessed on actual, which means it is a year the taxpayer realized that gain. That is a year the tax will be imposed on that gain. We call it the actual. Actual year run from January to December and all that. So that is basically what is the year of assessment. And you should know that when we say taxpayer, a taxpayer can be a company or an individual. And you should know that in taxation, if you are assessing a taxpayer as an individual, it is a state internal revenue that assess individual. Like all this personal income tax. But if it's a company, it's the federal inland revenue that assess any income generated by company and all that. So you should know that. So the year of assessment for capital gain tax is done on the actual year, which means there's a year you generate, you realize that gain. That is the year tax authority are going to assess you. So you have to understand that. Now again, okay. Now, very important. Let me give you a format on how to determine the cap. Let me just give you format. The format, now this is the format, computation of capital for capital gain tax for capital gain tax. Remember, as I said, it's assessed on actual. This is just a format. You have sales proceed. Sales proceed simply means the amount the taxpayer sold that asset. Then we have incidental expenses. Now, Incidental expenses simply means those expenses the taxpayer realize or incur, in the course or in the process of disposing the asset. For example, agency fee, commission, you have to pay. When you want to sell an asset, you have to pay the agency fee, you have to pay the legal fee, accountancy fee, you have to pay all those agency commission and all that. So we call them incidental expenses. Any expense incurred in the process of selling the assets called, maybe you advertise for the asset, all of them are called. So you have to go and remove the incidental expenses first to give you your net sales proceeds. Then we have cost of acquisition now. Cost of acquisition. Now, cost of acquisition here is comprised of purchase costs. Purchase cost means the amount the taxpayer acquire the asset. Yeah. Then we have maybe improvement cost. Maybe the taxpayer, when you acquire the asset, you improve the asset. Maybe advertisement also. You also incur maybe agency, because when you buy an asset, you have to pay an agent. Then any other costs of acquisition. Other cost of acquisition. By the time you add them, you take the head. Minus whatever you have, it will give you your capital gain. 10%. So for me to get my capital gain tax, CGT, is 10% of the capital gain. 10% of capital gain will give me my cap. So that is how to determine. You just remember, as I say, incidental expenses are many. It could be advertisement, legal fee, accountancy fee, and all that. Any expenses at all you actually incur in the process of disposing the asset, you must go and remove it first before you have a net sales. Then here, cost of acquisition means all the expenses you incur cost in the cost of acquiring the asset also removed. So whatever is left is called the capital gain. 10% of that capital gain is called the capital gain tax. So, okay, now let me just explain one or two things now. You know, remember in taxation generally there are various things we call allowable and disallowable expenses. Also here, under capital gain too, we have what we call the allowable expenses and disallowable, which means we want to look at what are those allowable, what are those expenses that are allowed by tax authority, because there are some expenses that are not allowed by tax authority. Yeah, which means if you file your tax return to them and you show them those expenses, they are going to fund as such expense. Why? Because those expenses does not meet the criteria of, those we say every expense before an expense can be allowed, that expense must meet a particular criteria. The expenses must be wholly, reasonably, exclusively, and necessary. These are 4 litmus tests that expenses must meet before that expenses can be called an allowable. Yeah. So now again, let's also look at whether we have some allowable and non-allowable. So, but let's start with allowable. Allowable expenses here. Expenses that we can consider as allowable. The first expense is what we call the purchase price of the asset. The purchase price of that asset. So, when we are dealing with purchase price of the asset here, what I will say here is that the cost of acquisition, this actually make up all the costs of acquisition. They are all the costs of acquisition. So, which means these are the costs the company incur in acquiring the assets is the purchase price. Then, of course, it's an allowable expense. Then we have what we call the improvement cost. Improvement cost is talking about any costs that the individual taxpayer incur in the cost of in the process of improving the value of the asset is called the improvement cost. So, which means that expenses too is allowable expenses. Then we have what we call the incidental expenses. Incidental expenses are those expenses that are incurred in the process of disposing that asset are called so these are the expenses. And remember, I said there are many. It can be can be advertisement, legal fee, agent commission, agent fee, accountancy fee, and any other expenses that is, towards the disposal of an asset. So these are basically unallowable. Any expense that's not here, that expense will not be allowed by tax authority. So now, again, let's now look at what we call the chargeable assets. When we say chargeable asset, we mean assets that are subject to capital gain tax. That's what we call the chargeable asset. Any asset that is subject to capital gain tax is called chargeable asset. Number one, we have PP, property, plant, and equipment. Any asset, which means motor vehicle, land and building, fittings and furniture, are all subject to our property. Then we have what we call the options, debts, and incorporeal property, like goodwill. Options, debt, and incorporeal property are goodwill and all that. Then we have stocks and shares, Then number four, any currency other than Nigerian currency. So these are chargeable assets under the capital gain tax. These are the chargeable assets. Remember, PPE, options, debt, and incorporeal property, stock and shares, any currency other than Nigerian currency, and all that will be subject to what we call capital. So that is that. Now, remember, capital gain tax actually is a bit wide topic. There are several aspects of capital. So now, we want to pick an aspect of the capital gain tax now and deal with it in this session. Yeah, we want to deal with an aspect of that capital gain tax, and then we'll deal with it in this session. So, in that now, so let's look at. So, I want to now look at one aspect of capital gain tax that is called the rollover relief. It's called rollover relief. Yeah, it's an aspect of capital gain tax. It's called rollover relief. Okay, so now we want to now look at a particular, aspect of capital gain tax that is called rollover relief. Yeah, it's one of the major aspects of capital gain tax called rollover. Now, of course, what is a rollover relief? Now, of course, a rollover relief occur when a taxpayer, use the cess proceeds of the disposal of an asset to acquire a new one. It's called this rollover, which means when a taxpayer use the cess proceed on the disposal of a particular asset and then use that cess proceed to acquire a new asset, that is called rollover. Which means if I have an asset, let's assume I have a plant and machinery. Of course, maybe the sales proceed, and I sell that plant and machinery, maybe for 1.5 million, I sold that plant and machinery. Of course, you see, that, okay, let's assume the cost of that plant and machinery maybe is 1.3 million. Let's assume it's 1.3 million. Normally, 200,000 is my capital gain. Capital gain is 200,000. Normally, tax authority is supposed to assess this 200,000 naira. Yeah, because anytime you dispose an asset, that's any gain on disposal must be subject to capital gain tax. But if the taxpayer now use the sales proceed, this 1.5 million, and I say, okay, please, I want to use this money to go and buy another asset, another plant and machinery, which means this 200,000 will not be subject to tax. That taxpayer is going to enjoy what you call a rollover. Yeah, they are going to roll over that, which means it's going to enjoy a relief for using the money to acquire a new asset, of course. Yeah, so that's a concept behind what you call a rollover relief, which means whenever rollover relief occurs, whenever the taxpayer uses the sales proceed on the disposal of an asset to acquire a new asset, which means that taxpayer has to enjoy a rollover relief. Okay, now let's now look at what are the types of rollover relief. we have types now. Types of rollover relief. What are those types of rollover relief? Of course, the first one is what they call full rollover relief. Now, of course, full rollover relief occur when the taxpayer uses the sales proceeds, uses all the sales proceeds on the disposal of that asset to acquire a new one. It's called the full rollover value, which means if I sold an asset, I sell an asset for 1.5 million, and I use the whole of that 1.5 million, or even maybe add another amount of money on top of that 1.5 to acquire a new one. It's called full, which means use all of the sales proceeds, or even more than that, to acquire the new. It's called full rollover relief. Then the second one is called the partial rollover relief. Now, partial rollover relief occur when the taxpayer used part of the sales proceeds on the disposal of an asset to acquire a new one. Yeah, it's parts. For example, I sold an asset for 1.5 million, and I used 1.3 million to buy a new one. That's a partial. It's not full. It's a partial rollover relief. Yeah, so that is that. Then, of course, the third one is no rollover relief. So these are the three types of rollover. So now let's know what are the conditions. Conditions for granting rollover relief, because it's not free. There are conditions that must be met before a taxpayer will enjoy a rollover. The first condition is that the assets must be owned by the taxpayer. The asset must be owned by the taxpayer, which means that asset that to enjoy rollover relief must be owned by the taxpayer. Number two is that the sales proceeds on the disposal of the assets must be used to acquire the same class of the assets. When we say the same class means, of course, if it is a land and building you sold, you have to use the same money to go and buy land and building. Not that you buy land and building, you sell land and building, and use the money to go and buy stock and shares, and you expect tax authority to grant a rollover. No, it must be the same class of that asset before you can enjoy rollover. Then the third one is that the taxpayer must apply. It's not free. You must apply for that relief before you can be granted that. Then of course, that asset must be used for the purpose of the business and all that. So now, these are the conditions that must be made before. Okay, so the fourth one actually is that the disposal or the acquisition of the new asset must be done within 1 year. Yeah, the acquisition of the assets of the new asset must be within 1 year, within 12 months. So before you can actually enjoy that. So these are the conditions. The asset must be owned by the taxpayer. The sales proceeds on the disposal of that asset must be used to acquire the same class, the same class of the asset. The taxpayer must apply for them. Of course, the acquisition of that new asset must be done within 12 months. So these are the conditions that must be met before a taxpayer will enjoy. So now, okay, let me just give you a format for this one, for this rollover. How do you know that an asset, has been, there's a rollover on a particular asset? You want to look at how do you know there's a rollover on an asset? Because remember, okay, for the rollover,
if you are cleaning the board, don't talk. So that I want to cut those places off. So repeat again.
Okay. So in this case, we want to now look at a format on the rollover relief. Okay. Yeah. How do you compute for rollover? If you want to know, okay, a rollover has occurred. Okay, let me just give you computation. Computation of rollover, rollover relief and capital gain tax. Let me put the two together. Capital gain tax, for example. If you want to know whether an asset has a rollover. Okay, for example, remember, this is a format. You have sales proceeds first, then cost of acquisition. Remember, let's assume the cost of acquisition. If you minus, sales proceeds this one, then cost of acquisition, you get your capital gain. Capital gain. We're assuming here, I just assume that, let's assume we don't have any incidental expenses and it's only these two, so we get capital gain. Now remember, if you use the same, now remember as I said, if you use the sales proceeds to acquire the asset, that this amount will not be assessed. So you have to go and calculate now roll over relief. And for you to get your rollover relief now, please know that it's the lower for you to determine rollover relief or roll amount you roll over is the lower of the sales proceeds. That's the sales proceeds or the amount reinvested. When we say amount reinvested, we mean the cost of the new asset you buy. Because remember, you have used the money to buy a new asset. So now we want to know between the sales proceeds and the amount of the new, that's the amount you invested, the amount you invest to buy the new asset you buy. Between the sales proceeds, which one is lower? So whichever is lower between sales proceeds and the amount you or buying or the cost of the acquisition of the new asset, whichever is lower, you are going to pick it and I say less again